2025, because even if the economy slows in an election year, they'll just stimulate more. And that's the struggle I have, is that, if you have a blow off top and some, I've seen some of your stuff, like you could have a 1929 style thing. I'm like, I don't think you can, because they just print money and optically it debases the currency. So how do you get that?
Sure. But I think we're down to the point where we're going to see whether liquidity or the business cycle will actually come through, and what will dominate one or the other. And I think what I see, if you look at the business cycle, and I got a few charts I can share also, I mean, we got a perfect setup for a 2008 scenario again, and even worse this time around. We got a business cycle that is now getting long in its tooth.
So I think we're in a new cycle, not an old cycle. I think we hit the bottom of the business cycle.
Yeah, but that's what I want to challenge, because I think that you are, I know, maybe a little too early there. Can you see my screen?
Yes, we can. So you're talking about why is a recession on the cards. So can I just, before we get into it, can we just confirm, Raoul, you're saying, you're both saying that we're going to be bullish. You're both saying that the core of the bullishness is the US debt and printing of more money and more liquidity.
And we haven't had that yet. So it's that's one thing. But I know it doesn't make a lot of sense yet to sit. But what I want to show here, for instance, is the yield inversion. We have the 10-year minus the 2-year here. And we all have been talking about that over the last year. And we know that that's a normal recession signal. And what you look at here is going back to the 90s. We had when the bottom is in for the yield inversion, we actually have a period before we see the recession set in. And this time around, we had exactly that. We had the bottom there in June of this year, and now we see the steepening starting. And we know that we'll need a little time for that, because what we see there is actually this, the deterioration of the economy. So what I'm saying here is that, well, we got until June, let's say quarter 2, quarter 3, where we should start to see the steepening getting even worse than what we have here. And this is one indicator. So again, just an indicator. If we look at the industrial production, what I look at, as I said, is momentum analysis. And what you saw into the great financial crisis here was a negative with the leading indicators, with the market yields and so on. All this is in place, and yet we're saying, oh, but we expect liquidity to save the day. So I agree with you, Raoul. I think we're going to see a huge surge in whatever the Fed is going to come out with here in terms of liquidity. But I don't think we can beat the business cycle here. And that's why I say by not even end 24. I think we're getting into this by, let's say, Q3. We should be in a recession already. So I think the market will top already in May or something like that.
I'm interested to hear Raoul's view here, because my view here is that we'll go into recession just before an election. That it just sounds so.
We did that in 2008. We did that in 2008. And that was the last time we had a real recession. So, I mean, it's not so uncommon. Now, we had the recession started in 2007 in December, and then you had the real fallout in September, actually just before. So that's wouldn't be too unusual.
Okay, before I let Raoul comment here, when you say that there's going to be a global melt up and a blow off top, you're saying that there's 6 months left until we get this global top.
After Corona, you had all this stimulus coming out, and every company around the world was doing fantastically. So they build up their capacity. And now they've been sitting on their hands and saying, oh, we didn't really see the demand coming back. So we'll just wait another 6 months and see how things are going before we start laying people off. And that's why we have seen this, stubbornly strong labor market so far. But I'm still saying I will cheer for the, I think the business cycle will come through and the liquidity will not be able to hold it up. But absolutely, they're going to pour a lot of liquidity on this, and that's going to create another situation. I think they're going to bounce the economy, but then they're going to bring it right into a stagflationary situation, and will be completely different. So I think we'll have a double, first a deflationary bust, which will be met by liquidity. Then we'll have a bounce, and then we'll see that we actually get a stagflation, which will be much more difficult for them to do something about.
Okay, Raoul, what do you think? I mean, it's different from your thesis.
Yeah, it's very different. It's 180-degree opposite, but there's several people with that same thesis. And the price by the amount the balance sheet went, it was just debasement of currency. I don't see how you can have 2008 once you've got the money printer.
Well, if money printing was the solution, I'm sure Weimar Republic would have been a much better,
But I mean,
had a much better pace than it did. So I don't think money printing will actually be will be the saver of the day here. And I think you actually will see now this time around that the free lunch is over. So you can do money printing. You also you had it before the French Revolution. Also, you had positive effects from money printing back then as well. So money printing will help you so far because it will get people to start spending. It'll get people to start taking on debt. But the problem with this time around will be that people already are in debt, and they saw how hard they can get hit by the high debt level, because when the interest rate starts to go up. So if you're imagining a situation now that they are going to lose their job, and I think we are slowly seeing the rounding bottom on the in unemployment curve. I think when people are starting to get unemployed here, they will be more cautious about getting new debt.
Any further?
Look, everything has a possibility and everything has a probability. I don't see where the systemic problem is. We all understand how big the debt is, but we figured out, don't forget, households have been deleveraging now since 2008. Corporates access the bond market, and there's still a starvation for yield that comes out of the pension funds that supports it. And if we look at what the Federal Reserve are doing, they want to lower interest rates anyway. And they've been injecting liquidity into the system. I just have a faith that everything changed in 2008 and that most people don't understand this. And maybe I'm wrong. But 2008 was a watershed moment in the change of how things work. So what they're doing is mutualizing the payment of interest
in June, and then a cut in July, and then no cut in September. But I mean, is this a little bit optimistic, do you think, by the market? Do you think the market expectation for the decline of interest rates is a little optimistic? To me, it seems a little optimistic.
Well, if Henrik's right, it's not optimistic enough.
Absolutely not. Exactly.
Well, this is exactly
right. They're going to cut it. They'll cut it really quick, and they will be forced to. And if you look at the normally you see the pace where you see interest rates are rising or the market rates are rising, you'll see them coming down even quicker. So I think you're going to see a tremendous decline in market rates, market yields over the next coming months here. Into the late of 24, it'll be really quick, and the Fed will try to follow suit. So they will have to cut a lot by the end of. And the reason why you do that, and when you see market yields coming down like that, is because you're in a recession. So we are not in the recession yet, and that's also
crypto macro. We tack on another 100% plus in the Nasdaq, and we tack on another 500% in crypto plus. Broadly across the board. And there's the other thing, which is this is going to be a much bigger bubble into 2025 because kind of all the elements are in line. Now, I think there's a 20% chance of that. That could have a longer hangover for the next cycle, but I don't see the cycle has changed here. It's been like clockwork, based around the debt cycle. It's been managed the same way every single time. Interest rates go up, growth slows, the Fed or one of the other central banks stimulates, it kind of bottoms the cycle out. I think most assets priced in a recession last year in 2022